All right, we're back. We want to do one of our calls of the day. It's to you, Jim, because it's Disney. And it's Keybanc. 5 reasons to step aside on Disney. They downgraded to sector weight. You know the reasons. I mean, DTC sub-growth is stalled, number 1. Domestic parks expectations appear too high. And there are a few other reasons, obviously, as well. I don't need to go through all of them. The point is, step aside, they say.
Yeah.
For a stock that really has been a dud.
It's been a dog. It's been a dog. I'm trying to muster up the energy to come in here. Look, I'm not going to sell it here, so let's just start with the action. If you own it, this is not the price to sell it. That doesn't necessarily mean come in and load the boat here. I think the most important thing I can say relative to this analyst report is there's nothing new. He may be right, he may be wrong, but there's no, like, I didn't wake up this morning and say, what's new at Disney?
Maybe, you know what, maybe investors, just if nothing new, need a reminder of the challenges that exist if they are reevaluating for themselves whether they should stay in the stock or not. I think that's a fair thing to make a call on.
I'm not taking issue with the analyst. What I'm saying is there's nothing new for me today. So I went to bed last night not thinking about Disney, but if I had, I would have said, okay, I'm going to own it to the next quarter. I'm going to see if Bob Iger's cost-cutting turns around. I'm going to see what corporate action he's taking vis-a-vis Hulu or ESPN. And at
what were you
this
thinking
price,
about? What were you thinking about when you went to bed?
He
were you
was thinking
of
about Disney.
Cliffs? Paramount? What were you thinking about?
Dude, I was thinking about Delta Airlines. I was thinking about, you're kind of harsh today. I was thinking about Wynn Resorts.
You walked into that one,
I do take issue with the downgrade.
You do?
Good. Take the heat off of me, Josh.
Yeah, I do.
Go.
All right, go ahead.
I think that I don't own the stock, and it's been a falling knife for more than a year. And just technically, $88 was support in January. I think it's going to break $88 and establish a new multi-year low. I don't think it's like a great buy here, but this is a clown grade. This stock is trading 22 times forward earnings and is in a 58% drawdown. So I agree with Jim, like, why now? Do you have something new to come to the table with? Or are you just telling us ESPN is a challenging situation? Like the rest of us are sitting here eating paste and waiting for you to point that out. We all know that. That's why the stock's lost 2/3 of its market cap. Why today? Why now? Makes no sense. I don't own it. Thank God. I have my own problems. But this is where I start to get interested in a situation like this. So if we see this stock with in the low 80s, maybe even a 7 handle, I think that's possible. That's where I'm like looking to first get involved, not looking for more reasons to sell. The reasons to sell are very well known. We all get it.
Well, Steph got it.
And by the way, one thing, cost cutting is not the issue. The content sucks. That's what they have to fix, and that's Bob Iger's specialty. The content is the problem. Every one of those Marvel shows was a dud. Every one of them. They have serious content problems. This new Pixar movie that they put out was an abomination. Nobody went to see it. I think they did $15 million in box office. I could have told you from the previews alone, no one's going to see this movie. So that's the part that Bob Iger actually can fix. Cost cutting is obvious. Right. That's what all of the big media companies are doing. So I think there's a better opportunity to buy it than today. Okay. I definitely would not be a seller.
All right.
I love it when
Siskel,
Josh
Ebert, and Brown.
I love it when Josh backs me up. It feels so good.
Well, Steph, you sold it, what? I don't know, a couple months ago?
Yeah, I mean, I made a little bit of money, not as much as I thought I was going to. I think that this is a value trap, quite frankly. I think it's going to take a very, very long time for them to turn this around. And why I sold it, sounds like they're going to buy the remaining interest of Hulu. I don't want them to do that, to be honest with you. They already have a levered balance sheet to begin with. Streaming competition is a nightmare, and I think that only gets worse going forward. And cost cutting, yeah, they got a $5 billion cost cutting program, which I always kind of like restructurings and cost cutting. However, last quarter, they talked about cost cutting on the content side. That's not good. They actually need to help and improve the content, like Josh just said. And I just didn't like that combination of the three. And at 23 times earnings, I don't find it compelling at all.
Jim, I'll give you the last word to wrap that one up.
Yeah, I just don't think this is the price to sell it. Look, I have a 25 stock portfolio, which means there are quintiles of stocks I love. This is in the lowest.
You'd rather wait for the 70s?
I mean, okay.
I'm just kidding. I'm just kidding.
I know you're just kidding. But no, I don't think this is the price to sell. It is not a stock that I'm in love with. I don't go to sleep. I don't wake up in the morning thinking about Disney. There are other stocks. And yes, Mr. Smart Guy, it is Cliffs. And yes, it is Boeing. And yes, it is Wynn Resorts.
Okay. TJX. I don't know if you're thinking about that one either in the evening or the morning. But Stephanie Link owns it, and it was initiated overweight at Piper Sandler. Price target $110.
Yeah, and this one's been kind of disappointing year to date in terms of performance. I thought it would have done better, just given that high inventories benefits the off-price retailers. And in fact, the senior VP and an IR person just about a month ago was on the road saying that they're seeing all kinds of great deals that they're getting because there's such excess inventory out there. So you have better pricing, right? You have better buying, and that increases your basket and your transactions. And they talk about 2 to 3% comp growth, and that's kind of what they have been doing. And I think the real change this year will be gross margins. They should improve as freight costs come down and supply chains ease. So I still like this one a lot. I hope it plays catch up because it's a quality company to me at a good price.